Hi, everyone, and welcome to this wealthmanagement.com Fast Chat. Today, I'm talking to Nick Milliken, the Managing Director and Head of Investment Strategy with Case Group. Nick, thanks very much for joining us.
Of course, great to be here as always.
This is a fast chat, so I'm going to jump right into it. We've seen a lot of volatility in the markets. Inflation is here to stay, it looks like, making it much more difficult for advisors and their clients to find opportunities in the public markets. What's going on there? How do you view it?
One of the most dominant trends of the past decade has been the shift to passive strategies and solutions, which represented an unlocking of access to cheap beta writ large. Since we're clearly undergoing a regime change, which may see leadership of market dynamics shift from accommodative policy to secular tightening, investors will likely need to access skill-based alpha strategies. We've seen a degradation in the alpha-generating capabilities of the traditional asset management industry over the past 10 years plus, evidenced through a large portion of the industry failing to beat performance benchmarks on a net basis, leaving private markets and alternative strategies like hedge funds as almost the final frontier of active management with the ability to generate alpha. Now, not all strategies can deliver persistent alpha, and the dispersion of returns in private markets is significantly greater. But all of this means that due diligence and manager selection become increasingly important in the asset allocation decision when considering alternative investments.
Yeah, so the public markets have certainly shrunk, less opportunity there. Advisors, clients looking to alternatives, private markets for some of that. But jump back into it for a minute, given the bond market, how that's sort of fallen apart. How is the traditional 60-40 portfolio that most advisors have traditionally held to, how has that performed, and how dire is it for that kind of portfolio going forward?
So the 60-40 portfolio, as represented by the Bloomberg 60-40 US stock bond index, is now down about 9.9%, which is the worst start to any year at this point in the year over the last 30 years. So while this is being predominantly driven by the equity sell-off, bonds have also been contributing to the decline. So the US aggregate index is down 8.3%, which is actually 3 times more than the second worst start to a year over the past 30 years, which is actually 1994. And if we go back to 1994, that was the year the Fed started its last aggressive rate hike program, where in 12 months they saw rate increases by 300 basis points. 225 basis points of that, though, came from 3 50 basis point hikes and 175 basis point hike as well. So to put that as context around it, I'd say that things have got a great deal more dire given the recent sell-off in bonds.
Yeah, it makes sense. Looking at the private markets and alternative asset classes, anything there that jumps out at you that advisors might want to consider during times of volatility and higher inflation?
Yeah, so in terms of managing volatility, we see several strategies that have historically provided diversification to a traditional portfolio. It's important to understand that while the 60-40 stock bond portfolio has 60% exposure to stocks and 40% exposure to bonds, the predominant risk is the equity component that can make upwards of 90% of the risk for the portfolio coming from that exposure. So focusing on strategies that diversify equity risk, we see both direct lending and hedge funds in general as helping investors address the volatility of their portfolio. So to give you an example, for the 15-year period ended 2021, direct lending, as represented by the Cliffwater Direct Lending Index, returned about 9.5% per annum, with an annualized volatility of 3.7% and a maximum drawdown of 7.7%. That compares very favorably to stocks, where the S&P 500 of the same period returned 8.3% for an annualized volatility of 15.9% and a maximum drawdown of 47.7%, a full 40% greater drawdown with more than 4 times the risk and less annualized return. So we can see that direct lending could be an effective hedge to the equity exposure within a portfolio. When it comes to inflation, though, real assets and asset classes and strategies that have physical assets in place and in use, and where the rents for the use increase along with the rate of inflation, we think things like real estate and infrastructure, specifically where owners and landlords can increase the rent high to compensate for the loss of purchasing power. Interestingly, we looked at Bitcoin as both a global macro and inflation hedge, and there just isn't enough data to make the case for the latter use case in the inflation hedge, but it may be a good high volatility diversifier to traditional investments like stocks and bonds.
But still very speculative. Yeah, high volatility for sure. Any other trends that you're seeing in the alt space and why that might be the case?
Yeah, so advisor adoption of and allocations to alternatives continues to accelerate as the broader markets have exhibited the heightened volatility and increased correlation given the secular shift in global monetary policy and tightening, as we've been discussing. But over the first quarter, we've seen growth in flows to both private markets and hedge funds at a rate of about 150%. So breaking that down, we see that private markets, both equity and debt, almost doubled in volume of inflows onto the CAIS platform as return expectations in public markets compressed and advisors look to enhance returns. Allocations to hedge funds increased 80% over the quarter as advisors sought to use these strategies to diversify traditional sources of risk and dampen overall volatility. And one final trend we saw was advisors embracing more liquid alternative investment structures like interval funds and lower accredited product. Non-accredited and accredited product has seen a year-over-year increase on the CAIS platform of about 710%. So really interesting dynamic there, people really looking to those liquid structures. But if you look at quarter-over-quarter growth this year so far, that really favors non-accredited product, which added about 70% in growth in flows, while accredited product continues to see the same level of high demand.
Nick, what are some examples of asset classes strategies that you're seeing on the CAIS platform where flows are going, and why, do you think?
Sure. So 2021 saw hedge funds continue the strong absolute and relative returns they exhibited at the peak of the pandemic in 2020. So not only have advisors been seeking to diversify portfolio risk, they've been seeking out hedge funds for their non-correlated, non-directional return profile. So if we look specifically at a couple of strategies, the value orientation of relative value strategies saw the most interest in the first quarter of this year as advisors look to take advantage of the market rotation from value to growth, as well as to capitalize on the dispersion and dislocation in global risk assets. These funds accelerated inflows on the CAIS platform by about 210% over the quarter. The highly diversified nature of hedge funds, as well as their strong risk management frameworks, also helped that strategy gain interest from advisors. They're up about 180% over the quarter. And equity hedge strategies continue to attract attention in the face of broader equity market weakness, with equity market mutual funds continuing to accelerate in allocations from advisors. And finally, the idiosyncratic nature of event-driven strategies such as activist and merger arbitrage saw continued interest over the first quarter, accelerating inflows by about 120 and 220% respectively, as they offer truly uncorrelated drivers of return over a full market cycle. But one very interesting trend was that inflation firmed over the quarter, and we saw advisors shift toward hedging this pressure to real estate and infrastructure. So real estate was up about 200% year over year, and value-added focused infrastructure was up about 90%. So while the floating rate structure of private debt, and more specifically direct lending, continued to be in demand by advisors, the inflation-fighting, lower interest rate sensitivity, and the real and physical nature of the assets backing those strategies such as infrastructure and real estate were the most appealing to advisors that we work with. And finally, as 2021 came to a close, the final 10% step up in basis component of the Qualified Opportunity Zone program actually expired. And so into that expiry, we saw a significant increase in demand from advisors seeking to take advantage of the tax benefit, with flows increasing about 170% year over year. Despite that, though, we continue to see support for the program into the new year, since the major tax benefit associated with the program itself actually comes from the elimination of capital gains on a QOZ investment if it's held for 10 years or more. So we're seeing quarter over quarter growth in flows there as well.
Fantastic. Great information, Nick. Thanks very much. Nick Milliken, Managing Director, Head of Investment Strategy at CAIS Group. Thanks very much.
Cheers. Thank you.